Now, I think what's really happened is we've got to act together. I mean, over the years, we've been developing these different products. We've got about 25 different products. And I think for the first time, we can really say that we're kind of firing on all cylinders. The only exception to that, of course, is the transactional banking, which is still in its formative years. So that'll take a while before that really fires. But everything else is firing. And we've done very well in building up these businesses and achieving the efficiencies and the critical mass necessary for them to succeed. And they're all synergizing well together. So I think it's really nice to see this whole thing come together. And this has really been our plan over many years, and it's only really starting to materialize now. So we're seeing the benefits now. Well, business banking was very successful. Of course, capital was very successful, but it's a very small division. There, the growth in profits was even more. And we're seeing very good benefits there from this new investment banking product of ours, and the private equity product is doing very nicely. The wealth area is doing very nicely, and we're very excited about that area. The commercial solutions area, was good, but it didn't kind of shoot the lights out. And of course, the treasury has been good as well. Well, we loan money to businesses, right? I mean, that's obviously what business banking does, and it's across a wide spectrum of businesses. So first of all, we've obviously, we're getting the benefit of the fintech business, which was only acquired basically on the last day of the last financial year. So you're not seeing a growth in assets as a result of the fintech acquisition, but you are seeing a growth in profits. So a lot of the revenue growth comes out of the fintech area. But as far as the growth in assets are concerned, it's difficult to say exactly where it's coming from, because it's coming from the whole spectrum of our product offering, which is trade finance, debtor finance, equipment finance. It's really covering the whole spectrum. In fact, there's a breakdown in this graph where you can see how the different units have grown in size. Of course, yes, definitely. Look, we've been lenders for a long time. We've been lenders for something like 40 years. And we've built up a fair amount of experience in good and bad times. We're obviously facing bad times now, so one has to be, more careful. But we're still in business. We're not, so one has to be selective. We're very security-minded, so most of our lending is in some way secured, either self-secured by the asset that we finance or secured by other assets. But yes, you're right. We've got to be careful, and we are being careful. I hope we're being careful enough. Okay, so first of all, to some extent, to quite a large extent, that increase in impairments is portfolio impairment as opposed to specific impairment. Because one takes a bit of a forward look at your book, and because the economy has taken a dip, has taken a downturn, and is likely to remain in almost recessionary, if not recessionary, conditions for quite a while, we look at the portfolio impairment, and we've increased our portfolio impairment. So that's just a general across-the-board impairment. Where we are seeing difficulties with our clients, it's to a large extent the mining and construction areas, some in the agricultural areas where they've taken strain from the drought, some even in the retail areas where there's been quite a shift in retail spending. So, you're seeing, although all those areas taking a bit of strain. watch our clients. We're very close to our clients. So, you know, we keep our finger on the pulse, and as soon as we see issues, we deal with them. You know, we don't just wipe them under the carpet, so to speak. The only way we can grow in times like this is by increasing our market share. And that's what we're doing. We're increasing our market share. Our market share, as I mentioned earlier, is very tiny. It's so insignificant that the big banks don't even notice us, really. And we're increasing our market share. So we're going from 1 drop in the ocean to 2 drops in the ocean. But we're still very small in that ocean. So that's the way we grow our business. And clients come to us because they like we're very hands-on, we provide a very deep service, a deep personal service to our clients, and they need that in times like this. You know, with these smaller businesses, they don't want to be just treated by the big banks as just a number. You know, they want that high touch, and that's what we provide. So they have difficulties. We help them through their difficulties where we can. If the client, on the other hand, is not playing the game with us, then obviously we're going to take a harder line. You know.
So I think we underestimated the challenge, you know, of building this new business when we set out on it about 1.5 years ago. That being said, we have built the unit, and we've invested a lot and are investing a lot in terms of our client propositioning. We've got a series of technology-orientated projects which we engaged in, whereby we think that we will be able to deliver transactional banking more seamlessly to our clients in a way which will help them manage their cash flow better, which often is not the case for clients that bank with the bigger banks. We're very focused on the business segment of the market, and in the next few months there will be some value-adding enhancements which we're going to release to market, and we think that those will enable us to obtain better market share.
It's a long-term project. We always knew it was a long-term project, even though, as Michael says, we might have underestimated how long-term. But we don't see transactional banking as being a big money spinner for Sasfin ever, really. It's not our aspiration to be a big player in transactional banking. What is our aspiration is to improve our service to our clients and to attract new clients through this offering. And then, of course, once a client's on your books, you can offer him the whole spectrum of services. So it's more of a catalyst than anything else. But it'll still take a couple of years before this unit kind of washes its face, if you like. You know, it's very difficult to look into the future on this thing, because it depends on how responsible or irresponsible our government's going to be. If they're going to be extremely irresponsible and do crazy things, some of which has been speculated in the press, then you could really move to junk status very quickly. You could see the rand collapsing, interest rates going through the roof, the country goes into depression, not let alone recession, it goes into depression if some of these forecasts materialize. On the other hand, maybe the government will be a little less irresponsible, and maybe the rating agencies will kind of give us a bit of a break, and even though they downgrade us, they may downgrade us in a more gentle way, and in that case you'll see that the rand will depreciate, but it won't be a complete collapse. So there's a whole spectrum of possibilities here, and one doesn't know which way it's going to go. If it's a real falling out of bed scenario, then of course it's going to have a very adverse effect on us and on every bank in South Africa. There's no question about it. But if it's a more gentle thing, we can handle that really well. So we've done our scenario planning. We can certainly cope with dropping interest rates, and we can certainly, an increase in interest rates, and we can certainly cope with a drop in the rand. I think it is to some extent priced in. We know that.
If there was not to be a downgrade, and we were managed, and our political leaders were able to navigate through the next few months positively, then you could even see a strengthening of the rand.
So we had a conference, the Business Day conference that we sponsored the other day with Pravin Gordon, and he was quoted as saying that he believes that chances are that we won't be downgraded.
But despite all of that, we see a lot of opportunity still in the markets.
But if you think about it, if the rand crashes, there'll be more import replacement. There'll be more export. So there can be a positive side to it as well. Higher interest rates works well for us. For all banks, you're going to get a high interest on your capital. So overall, it doesn't necessarily have to knock you for 6. But of course, if it were a huge movement, then all of a sudden a lot of companies are going to go insolvent. A lot of companies can't survive at 20 rand to the dollar and more. They just can't survive. It's no longer a viable business for them. So one has to deal with that fallout.